because most W-2 employees cannot have the losses go against their W-2 income
Right.
unless you marry a real estate agent. Reasons to marry a realtor.
Right. So, and one other thing that they do in these cost segs is they break the building down into 5, 15, and 27.5 year components. So can you break that down a little bit? Because even, we've done quite a few, and that still confuses me.
Usually by default, if a client were to build a property for 27.5 million serving long-term residential tenants, then that 27.5 million would to be depreciated $1 million per year over 27.5 years. Likewise, if you have a 39-year property with a $39 million construction cost, you would depreciate $1 million over 39 years evenly.
Welcome back, everybody, to Ladders and Leverage, the podcast where we dive deep into real estate, returns, and the real world work behind building financial freedom. Now, I'm going to be real here. Cost segregations, which we're talking about today, was extremely difficult for me to understand, and it took a long time. I kept hearing people talk about what is the secret tax code? But it really wasn't until we actually used it that in one of our own deals that it really clicked. So let me tell you a quick little recent deal that we closed on Harvard Villas. So we bought this building. It was a 24-unit building. And we closed on the building in November of 2024. So like right at the end of
2023.
2023. And so we did a cost seg with Anson, and for every $100,000 investor, the limited partners received a $33,000 paper loss on their K1 year one. So one of our investors, he told me afterwards that he had a $35,000 gain in 2023. So we own this building literally 1 month.
Literally. It was November 29th when we closed.
November 29th when we closed. And so he was able to take that $33,000 paper loss that we got from this cost segregation study we did, and he was able to apply it to that $35,000 gain, and he paid no taxes on that gain he had. So that is the kind of stuff that nobody teaches you in school, and that's why we brought on someone who lives and breathes this strategy. So today we are excited to have Anson, who has over 10 years of cost segregation experience. He started at Ernst & Young. He moved back into pre-construction in Denver while still doing cost segs on the side. Then he came back full-time and eventually joined Core Solutions, who we use for all of our cost segregation studies. And what we really like about working with Core and Anson specifically is they're not just engineers, they're advisors. They actually help investors understand how things work and how to use this. So, Anson, welcome to the show, man.
Thank you. It's great to be on here.
Yeah, man. I'm glad to have you. So let's kick things off here and give us a little backstory. How did you get into cost segs, and what kind of clients or projects do you typically work with?
I got into cost segregation more or less from my major at Drexel University, majored in business and engineering. So all the math and sciences were engineering, and then had to dabble in various areas of engineering. And one of them was blueprints, 3D design, etc. And so analyzing costs, looking at blueprints, set me up to be ready to join cost segregation at Ernst & Young right as I graduated.
Wow, that's pretty impressive too. Ernst & Young. I mean, that's a huge company.
Yeah, and to be honest, I had no idea who they were. They were introduced to me as EY. I was like,
Oh.
Okay, EY, yeah, I'll apply and do the interview. And I was trying to put pressure on this other company and didn't get that job, thankfully, and got a job offer from Ernst and Young, and then ever then it's been history
That
in the making.
is so cool, man. So for people who are hearing, this for the first time, how would you explain a cost segregation in simple terms?
Cost segregation is an IRS incentive to business owners to propel the economy forward. So money's already tight for people who don't have money, and it's more wisely spent for people that do have money. So in the IRS providing cost segregation, recovering those costs that you're expending into the economy, the IRS allows you to recover that via depreciation. So instead of stimulating the economy and then getting taxed on the revenue that comes through that, you are getting an offset or reduction in taxes by, you know, bringing business, building houses, renewing houses, making the economy more marketable, more valuable to yourself, and more inhabitable to those around you. Um, and the type of clients that benefit from this would be office spaces, retail, hotels, um, mobile home parks, residential homes, apartment complexes, any income producing asset, um, outside of no nonprofits and no government buildings for obvious reasons.
Wow, that's so interesting. It's funny because we talk to our friends who are extremely high W-2 earners, and they always complain about how much they pay in taxes. And I always say to Danny that it's because we are providing housing that the government incentivizes us to purchase more buildings, because otherwise, why would you take on all of this risk and responsibility? And so when you're
Mhm.
just a W-2 employee, you are not providing you're adding value, right, to your company, but you're not providing more jobs, you're not providing housing, and so that's why there's not as many tax incentives to those type of employees, and so I feel bad, but I'm always like, yeah, I mean, that's why our effective tax rate is lower because we're providing housing for people.
And because we have investors who are from all, spectrums. So we got people who own their own businesses, we have people that are in real estate, we have people that are W-2 employees. So let's bring it talk about that a little bit. So if you're a strictly W-2 employee, you're a firefighter, you get paid W-2 money. So from my understanding is that you if we do a cost seg and we have, let's just say, that $33,000 write-off, that W-2 employee cannot use that depreciation loss off their W-2 income. Is that correct?
Correct. There's um, two silos of how you make money: active income or passive income. That firefighter who has a W-2 job who just bought a rental property isn't doesn't qualify to cross-pollinate those 2. In order to have the benefit of buying a property, doing a cost seg, and using the losses from that to offset your W-2, you would need to be a real estate professional and/or perhaps married, and your wife or husband, is the real estate professional while you're the W-2. And that's how you would use the passive depreciation, the passive losses to offset not only the passive income, but also the active income.
So then that firefighter invested in our deal, he got the 33,000, and what happens to that paper loss that he got on that K-1 from the year? Does it carry forward? How does that all work?
If there is excess, then yes, it would carry forward until it's all used up in the following years.
Got it.
Which I think is the biggest, benefit that a lot of people don't understand is that that loss stays on your tax return and carries forward into perpetuity. So, you maybe, the building that you just purchased doesn't have any cash flow yet because, like ours, we're usually remodeling units and adding ADUs, but once that cash flow comes in, then that $33 or $33,000 loss, say it's a $5,000 cash flow on your K-1 of gain, can go against that 33,000. So then that $5,000 that you made in cash flow is tax free. So I think that's the biggest benefit for the W-2 employees who invest in after-tax money, that I try to explain to our investors of how it will benefit them eventually. But yes, it's not like you and I, where I've always been a real estate professional. You had your fire income, and we were able to take losses from, years that I didn't have good years or had large expenses and go against your income. And same with our rental income, because most W-2 employees cannot have the losses go against their W-2 income
Right.
unless you marry a real estate agent. Reasons to marry a realtor.
Right. So, and one other thing that they do in these cost segs is they break the building down into 5, 15, and 27.5 year components. So can you break that down a little bit? Because even we've done quite a few, and that still confuses me.
Usually by default, if a client were to build a property for 27.5 million serving long-term residential tenants, then that 27.5 million would to be depreciated $1 million per year over 27.5 years. Likewise, if you have a 39-year property with a $39 million construction cost, you would depreciate $1 million over 39 years evenly. Where cost seg comes into play is instead of waiting 39 years to get most, if not all, that depreciation back into your pockets, using it for something beneficial to you or someone else, cost segregation allows you to uh, identify and carve out accelerated depreciation for qualified assets. So some of the assets are inside the property, some of the assets are outside the property. Inside the property is typically 5-year property, distributed trades and services. Such examples would be kitchen cabinets, counters, appliance, plumbing hookups, electrical to appliance hookups, uh, blinds, curtains, curtain rods, qualified flooring, more or less any flooring that's not grouted or cemented to the floor. So 5-year inside the property, inside the building. 15-year property would be anything on top of the land and not attached to the building. So you got fencing, sure, besides 2 screws, if that's the attachment method, concrete pavement, asphalt pavement, curbing, bunch of those type of things. And that would be 5 years, depreciative over 5-year property, or 5-year property, depreciative over 5 years, 15-year property, depreciated over 15 years. And then the balance of that is depreciated in 27.5 years. And the for residential property that we've done work with Danny for, typically the minimum that we're looking at is 25% benefit of the depreciable cost. Rule of thumb would be 20 to 30% of the purchase price that you
Mm.
are buying a property with. We'd move into 5 and 15-year property.
Oh, that's interesting. I didn't realize that there was that metric that you were looking at when we were sending those over. So that's
Yeah.
good to know. So it's basically 25 to 30% of purchase price is what you're trying to advance into accelerated depreciation in that
Mhm.
first year of ownership, and then taking those losses, which then
Yes.
creates the losses, and then oh, very
Yeah.
interesting. I didn't realize all that.
Okay, so let's talk about, and I'm sure everyone here has been hearing about it, this big, beautiful bill that President Trump has introduced, and bonus depreciation, yay, back on the table.
Yeah, we're gonna talk about one aspect of it.
That's what we're talking about, bonus depreciation. 100% was in play. It was like rocket fuel for these investors. You buy one building, you do a cost seg, and you're writing off a massive amount of value for year one. But since 2023, it's been phasing out from 80% to 60, and now in 2025,
Are we at
Mhm.
we're at
40%?
40%. So
Yes.
Oh.
Trump recently introduced a bill that would bring back 100% bonus depreciation and retroactively apply it to the back start date of 2023, which is a huge game changer. So you're talking amending K1s, big paper losses, and potentially huge tax refunds for deals already closed. So, Anson, what would that mean in practical terms for investors who have already done a study, and what should people be doing right now if they want to take advantage of it. And is that all true, what I
Um,
just said there? Would it be retro to 2023?
Yeah, let's check Danny's AI, please. Someone needs to fact check his AI right now.
I mean, multiple times I've seen retroactive to January 20th of 2025 for sure.
Oh, okay.
Um, Obviously, it passed the House and Means Committee. It's passed the House of Representatives. Now it's into the Senate. Um, and right now, Trump and Elon are going at it. Like Trump or Elon is going back to 2011 saying, Trump tweeted this, Trump tweeted that, da, 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 da. Because the current tax bill, the one big beautiful bill, is apparently like going to create $5 trillion in deficit spending or debt.
Yeah.
So it's a battle of Doge, Elon's baby, trying to cut all the wasteful taxes or spending, and Trump trying to stimulate the economy with all these sorts of deductions and bonus depreciation. 100% bonus depreciation obviously is the best because stimulates the economy, gets everyone out of their houses into the marketplace, and there's a lot of depleted houses out there which need a lot of help. So getting 100% bonus depreciation, which is in essence deductions, expensing for the year, it's going to spur a lot of investments.
I have a question. So, obviously there's a housing crisis going on across the nation.
Mhm.
And can you do a cost we don't do any new development. So, can you do a cost segregation on new development once it is put into service? I guess you can.
Yeah.
Yeah, cuz we do it on our ADUs.
Hmm. Yeah. So
Oh, see, so that would then help spur developers with the high cost of construction and interest rates right now to have, the bonus of that depreciation, which then would, hopefully inspire them to pull permits and start building.
yeah, I mean the benefit of the cost seg, one kind of a tangent, but it fights against inflation in case the dollar keeps on getting weaker and weaker. Um, but also, if you were to buy a house and then there would be deflation, you still get to recover the costs from that inflationary purchase price that you made or inflationary construction costs that you incurred to build those houses. And you would have extra cash left over even in a deflationary economy.
So do large housing developers, do they generally do cost segregations?
Oh, yeah. I mean, anyone that's renting out a property, be it residential or commercial, they're doing cost segs. The only reason why they wouldn't do a cost seg is they're too busy closing on the property and running their business, and their CPA, be it a small CPA or uh, a big company internal CPA, they just don't have the bandwidth and or um, they're not advised to do a cost seg. A cost seg is most preferred to be performed by a qualified engineer per the IRS. That's the
And
most
yeah, and I would say
proof.
it's actually pretty difficult to find a CPA, or it was for us here locally, to find a CPA that deals with cost segregations because your normal CPA who does W-2 tax returns, what have you, they don't wanna touch it.
Oh, yeah, it's one, there's just I mean, per conversations with our CPA, there's fewer and fewer CPAs jumping into that, accounting market segment. So that along with just what they're teaching in college, it's basic gap finance or gap accounting, not anything special or specialized with cost segregation or real estate. So yeah, it's we get a lot of clients saying, "I need someone who knows about cost segregation. I need someone who knows how to even apply the depreciation from the cost seg to
Yes.
Mhm.
their tax returns."
Yep.
So it's not uncommon.
Have you seen, less cost segs being done because we're down to 40%, or is it still people are still taking advantage of it?
I mean, there's a decent amount of people, not near the quantity
Mm,
of early 2024,
mhm,
but as of April, May of 2024, everyone was like, "Oh my gosh, 100% bonus is going to come back." It's a lame duck, but that they'll at least get through the 100% bonus last year. And now uh, people have up probably through February, March of this year, it's been fairly consistent. And then the last 2, 3 months, it's are we going to get the bonus? Are we not? Is 40% bonus worth it? There's just so many, are the tariffs going to make building a house or repairing a house that much worse and more expensive. There's just so many variables um,
Yeah.
making people pause, and or everyone's buying a property now and they're just waiting to close on it. So
Yeah.
slight pause for a variety of reasons.
Yeah. That
That's
makes sense.
interesting. I mean, the cost of a cost segregation is really not that expensive compared to the value you provide your investors, like for us as syndicators, to even that 40% loss is still worth it. I mean, we just closed on a building. Purchase price we closed at was 8.5.
Yeah. We haven't done that one yet,
But when we were quoting to do it, because we're gonna do it no matter what, and even at 40%, when we put it in our pitch deck, you were saying it was gonna be this if we only get the 40%, or if the 100% bonus comes back, it'll
yeah,
be this. And, I mean, it was thousands of dollars, and
it's still like that 20. I mean, for our $100,000 investors, it was still in the $25,000 range.
was
So
it that high for that? Oh, yeah.
mm,
I mean, I think that, I just think it's interesting that people wouldn't take advantage of that for even 40%. Like, I mean,
it's still worth it. It's still worth it. I mean, I'm
100%.
I hope, 100% comes back, for a variety of reasons. But we're still gonna be I mean, we bought this one, Anson, in, a couple months ago, so we'll be calling you up here shortly for, this
Yeah, we
cost
just
seg
closed last month.
yeah.
Yeah.
Awesome. Congrats on that.
What does someone actually need to give to start a study?
I mean, the most basic information just to get a quote and see how much you can get or benefit from it. Purchase price, the date that it's ready and available to be rented, and then the address. That's the bare minimum. Address, purchase price, and date. It's going to be on the ready and available on the market. Not necessarily rented, but available and being marketed to be rented. Um,
So
obviously,
I give you that. I mean, because
Mhm.
I do this all the time when I'm, like, looking at deals. "Hey, Anson, we're looking at this deal," and, him being the engineer gets it back to me in, like, point 0.5 seconds. Um, so what do you do then? So I give you the address, I give you the, APN, square footage, all that, and then all of a sudden, voila, you go, "Hey, you're gonna get, you know, 1.2 million in bonus depreciation on that." So how do you, apply or get those numbers?
Right. We have depending on the property type you're providing us,
Let's like
we
multifamily.
yeah, whether it's a single family home, duplex, quadplex, apartment complex, those all have different ranges of benefit, etc. So for a single family home to a quadplex, you're probably looking at 25% benefit of the depreciable cost basis after you remove land out of the purchase price. For
Oh.
apartment complexes, you're probably looking at 28 to 32, 33%. Obviously, lower side of the range, more basic, not as well ornately fitted out, not as many cabinets, not as many closet shelvings or blinds installed originally. You can install those after and then get the benefit in a subsequent cost seg study, but between 25, I've seen as high as 39% for a single family home, but it was decked out with landscaping, rockscaping, pool, uh, putting green in the back. Like it was snazzy. It's really
Wow.
nice.
So someone bought that as an investment property and then called you to do a cost segregation on it? Because you can't do
Mhm.
it on your primary home.
No, I mean,
Okay.
if you were to get creative and create an LLC that you'd pay rent to, even though that LLC is yours. So if you have creative CPA people, then in theory, you're
That
not
is creative.
using it as your
Hmm.
primary residence, but
Yeah.
by the book, yes,
Yeah.
primary residences cannot be depreciated.
And then how long does the process usually take?
From the time you sign, if it's a desktop study being analyzed via pictures, as though we visited the property, 3 weeks to max 4 weeks, we would deliver the draft report for you to send to your CPA to review, adjust anything if necessary, and then depending on your CPA and how responsive they are, from start to finish, 4 weeks from the time of analysis. So it all depends upon the client. Are they on the ball, documentation ready? Then yeah, 3, 4 weeks. If they're busy, bogged down, CPA is not responding, has a bajillion other clients, then we've seen it unfortunately go as long as like 6 months.
Wow,
Wow.
that's not us.
No. Yeah, no, and that's true. Usually, about 3, 4 weeks for us when we start.
Yeah.
So then once it's done and, like, what's included in the final report? Is it, like, plug and play, ready to give to your CPA?
Yeah, so we provide the report. It's ooh, a little bit of pictures representing the major categories, the major areas of benefit. And then our CEO, Terry Judge, signs the report, and then we provide tax depreciation schedules showing the method, the convention, the date of in service, the 5, 15, 27.5 year categories, and then the depreciation by year for the life of the property. And then we provide that to your CPA, or we provide that to you, the client, who then provides it to their CPA, who then plugs and chugs into their software system. And then more or less the process is done.
Beautiful, beautiful. Yeah, it's really been I mean, that's why I mean, we've used other, cost seg.
Oh, on our very first one,
Yeah,
we did, yeah.
and then, yeah, we found core solutions, and they've been amazing.
Yeah, I think the reports are really easy to
Yeah.
read, and, now for me, I do all of our bookkeeping and back end, financials for all the buildings, and I'll say that, the very first one we did, I tried to create fixed asset schedules with the exact numbers, and then my CPA was like, "Marissa, you don't need to do that. You can put it all into one labeled 2024 fixed asset schedule," and I was like, "Really?
Oh, wow.
Do you know how many hours I took trying to?" Because I was trying to match the exact expenses, and then now Danny and I too have it more down where I'm like, "Okay, you can't just say whatever your budget was, I have to tell you because what has happened to us when you have a budget for a whole project and some of it is spent in 1 year and then it goes over into the next year. There was a year where he gave a cost seg and gave his budget, and not all of it was spent in that year. So
Mm.
now I'm like, "Let me tell you what my fixed asset line item is for that year, and then you say that amount, and then the other part has to go into the next year." So, we're getting this down, you know? We're
Yeah,
getting there.
we are. So I gave you that, Harvard bill as example. Do you have a favorite case study or a result that you can share from a client?
Uh, yeah, I mean, for like mobile home parks, which are
Mm,
getting more and more popular, we're getting like 75 to 85% benefit. So if you spend
wow.
$1 million, you're almost depreciating 600 to $800,000, easy peasy.
I have always wanted to get into mobile
She
home parks.
has.
Mobile home parks and laundromats were my first
You
loves.
have
I now
laundromats
have laundromats
in
at
the
all the
apartments.
apartments, but we might have to look into mobile homes. See, look at that. I had no idea.
Wow.
That's insane. Why
That
is that?
yeah.
Um, I mean, in the that scenario that I presented, the client owns the land and then the site improvement. So that's gravel,
Mm,
concrete pads, electrical plumbing connections to the mobile homes sitting on the pads, site lighting, fencing. But after you remove all those site improvements, you just have land, or the opposite. Once you remove land costs and you only own the land side of things, not the homes themselves,
Oh, okay.
then you back out 15-ish% for land, depending on what you and your CPA recommend.
Oh.
Um, and then the rest is more or less site improvements with a little bit of 27.5 for 39-year property.
wow.
Oh, I was wondering that. I was wondering if those were mobile home parks that they owned the actual mobile homes or if it was just they would just own the
Yeah, I
land.
mean, the mobile
So that
home
makes
parks,
sense.
um, for ones that they own the mobile homes themselves, I think we got 40-ish% on those, but those are not as frequent as the other ones.
Yeah,
Wow.
right. Most of them you don't own it. And then I guess the 15% here in California for land would be higher. I
We
mean,
use yeah, I was curious because 'cause we've gone back and forth on the land value.
I do it based on
Right.
the tax assessor
S
so that, should I be questioned, I can argue
s
that this is what it was based on the tax
where
assessor's
do you
value
find that?
on the property tax bill.
Oh, okay.
So I just take whatever it was uh, the previous owner's
Yeah.
tax bill, and then you just take the land. It has it right there, building and land, and then I just take the land and divide it by whatever the assessed value is to get the percentage, and then that's what the percentage I give for the land value on the new purchase. Usually it's around, I'd say,
23.
yeah, 23 to 25%.
Yeah.
If
Mhm.
we don't own in, like, I mean,
Because you do them all over, right, Anson? Not just California?
no,
Oh yeah, we do nationwide, whether it's
yeah.
Washington State, Florida, Texas, California. We're doing a project on Monday in California of this beautiful 2, 3 building single family home or multifamily short-term rental.
Oh,
Oh.
nice.
So is California typically have the highest land value?
Yeah, we typically use a rule of thumb of 25 to 30% for land value in California and probably in like Washington, DC, Massachusetts, more or less the coasts. You'll see the 25% rule of thumb. But given Core Solutions is not a real estate valuation company, we always defer to you and your CPA to whether it's using comps from a real estate agent,
Mm.
a tax assessor's property record, or another calculation, or just like looking up on Zillow what land is going for. So as long as the land value in your area that you're using for your own property is reasonable with the surrounding properties, that's what you should go with. Um, Aggressive is like 10%, or at least for the nation. We'll say 10% is aggressive, 20% is conservative, meaning 10% is your out of the 100,000 out of the $1 million purchase price, you're only allocating 100,000 of that to land. So if there's no building, no improvements on that land, that's what that dirt would sell for.
Mm.
Yeah, so, like, the middle of the
That's an aggressive
country.
client that wants to move as much money into depreciation.
Yeah.
Opposite, 20% more conservative, go by the rules, and just even go further away from the rules to where it's like, "Hey, don't audit me. I wanna just live a happy life, do my investments without getting audited." So,
Yeah.
but for California West Coast, yeah, 25, 30% is on average what we
Yeah.
see.
Yeah, and I actually that's funny, it segues into my next questions. One of the biggest myths we hear is, or maybe it's true or maybe it's not, people think that cost segs cause audits. Is there any truth behind that? You heard?
No, actually, when we've been audited with $127 million project in Alexandria, Virginia, passed with flying colors by PwC. Another one we had get audited because of a NOL issue. They did a cost seg in 2019,
What's
but
that?
they were
What's the
trying
NOL?
net operating loss.
Oh.
So for whatever reason, there something happened with this client, and they were trying to take losses from the cost seg study and other areas in their finances and apply it to like 2015, 16, 17. And then because of that side of things, then the IRS auditor had to audit our cost seg study.
Wow, they were really getting
Yeah.
creative.
See?
Yeah.
If you
So,
You're like,
but usually audits are just like, hey, what's your methodology? What's your rationale? And then after that first set of questions are provided and answered by us, it's passed. Like we don't get any follow-ups
Yeah,
because it's so good and thorough.
yeah.
yeah, I mean, our CPA, who I love and I wanna have on this,
Oh, yeah.
he loves when we have a cost segregation. Like, he's like, "This is great. This is so much easier to follow by," and he's like, "I just match it to the report and, there's no questions about it." Versus I had asked him on there was a property where we did an extensive remodel, a lot of remodeling in the year because we didn't do it upfront, the first building that we bought,
Mhm.
and I was like, "Oh, can we take accelerated depreciation on this?" And he was like, "Only if you're gonna do a cost segregation." And I think we looked into it, but our partner was like, "Eh."
That's right.
Yeah.
Yeah. So is this just for really big assets, or can smaller properties benefit from it too?
No, I mean, the fee is probably proportional to the
Mm.
purchase price of your asset. Um, Not necessarily exactly proportional, but we've done analyses on $100,000 properties, $30,000 properties.
Mm.
Obviously, someone with that 30 to $80,000 property has a portfolio of them, like 50 of them.
Oh, okay.
So the fee, you couldn't charge like 2,000 a piece, maybe
No. Yeah.
850 or $1,000.
Yeah.
But if you're looking at $1 million place or $10 million, then your ROI is growing towards like 50 to 90x, depending on what the
Yeah.
property is.
Yeah, and for people out there that are thinking about a cost seg, for us, we've done, from a 4 million to $8 million buildings, and they cost anywhere from five to $8,000, depending on
Well, and we've done it
the.
on 1.2 million. Didn't we do it on Acacia?
Yeah,
Yeah, we've done it on all even smaller
yeah,
ones. I think it's always worthwhile.
it's always been.
The one thing I think is amazing that people may not know if you're here in, California or maybe other parts of the country where you're adding ADUs to buildings, it's really cool because you can do the cost seg on the purchase, and then with Core, they then l take the ADUs and do a whole cost segregation on that, which is usually, another year later, but that's a substantial amount of
Yeah,
money. The ADU budget, depending on is anywhere from I think our smallest ADU is like 300,000 for 2 of them, and then our largest one will be around 2 million. So, I think it's definitely worth it, and it
yeah,
just gives you that extra, depreciation and loss for your investors 2
yeah,
years in a row, which is great.
yep. So, are there any upcoming tax changes investors should be tracking outside of bonus depreciation that you're aware of?
No, I think the biggest one is just bonus depreciation being 100% or 40% based upon this new bill.
Is it going to 20% or is it done next year?
If this bill passes, then it's going to be 100% from 2025 to the end of 2029.
Oh, it's 100% the whole time. I didn't know that.
Oh.
Yeah.
I didn't realize I thought it was gonna, slowly lower over
S
the
s
years, I
Does
guess.
next year go to 20%?
If
If
2026?
the
it
bill doesn't pass,
Yeah,
then yes, it would go to 20%.
and then 0 in
and
2027.
Yes. I mean, for one side of things, if you guys have any listeners or future listeners that are listening to this, I believe there's 100% um, expensing deduction for manufacturing. So if you were to build a manufacturing plant, provide the equipment,
oh,
etc., then that would be 100% deductible
Let's get into
in the new one.
manufacturing. Yeah,
bring back those factory jobs.
yeah.
That makes sense.
If someone's considering their first cost seg study, what's the number one thing they should know before jumping in?
Don't flip it within a year. You cannot depreciate an asset that you own for less than 1 year. So it
Oh,
has to be income producing, owned for minimum 1 year and a day. And if you do sell it a year and a day later from the time you rented it out, etc., then the recapture is almost as if you didn't do the cost sake to begin with.
oh,
Oh,
So
so it's pointless.
not for flippers.
Not
r-
for flippers.
Or quick
yeah,
flips.
not for flippers. Yeah, yeah,
Yeah,
yeah.
Oh,
But a way to get out of that is either 1031 exchange it or hold it for 3 to 5 years so
yeah,
that the um, net tax book value is much lower.
interesting.
yeah. I did
I d
not. I wouldn't even thought of that, but yeah,
no.
that's great. Thanks for sharing that. Okay,
Mhm.
we're getting to wrapping up here, and we're gonna do our final 5 quick fire round. All right, Anson, name a book that changed your life.
Between Rich Dad, Poor Dad, and then Boundaries. Um, the mentality of Rich Dad, Poor Dad versus like just W-2 working hard and
Yeah.
clocking out versus uh more or less going 1099 and just going for it. You put in the work, you get that much out of it. Um, and that's been the most rewarding thing of my life of just going for it, working 12, 16-hour days, being exhausted, but then looking back 2, 3 years later, it's like it was worth it.
Wow.
So Rich Dad Poor Dad and then Boundaries to make that lifestyle and, you know, having a family work all together.
Yeah, I think
Oh,
that is,
I haven't read that. I'm gonna have to
yeah,
check
you
that
need
out.
to read Boundaries. That would be a good one for you. I try to say to him all the time, like, just because your phone rings doesn't mean you have to answer it. People are you train people to have expectations of you, and if you're gonna answer your phone at 9 o'clock at night, they're going to expect you to always answer your phone at 9 o'clock at night, and
Yes.
so, that's what I try to say. I mean, being self-employed my whole life, basically, as a real estate agent, I had to learn this. I had babies, all sorts of things where it was like, I have to make dinner for my children, so I had to learn to not answer every text and phone call within 5 seconds because then my
Mm,
clients expected that all the time, and especially outside of business hours. I mean,
Mm,
your doctor, your dentist, they are not answering you back unless it is between business hours.
yeah.
So, unless it's a true emergency, I think that you gotta lay off it. All right,
All right.
buddy?
I'm gonna read that. So I'm curious, who recommended Rich Dad Poor Dad for you?
um, just ton of YouTube channels,
Yeah.
Okay.
Yeah.
trying to, learn how to make money or just be better in life. So of all the YouTube channels I watched 3, 4 years ago, that was one of the books everyone referenced.
Yeah, I could see that.
How old are you?
He's a baby. He's like 12
34.
30. Oh my god.
with a baby
Yeah,
face.
baby face. Yeah, good for you. Okay, worst advice you hear in your space?
Um, I would say, not a gimme or a cliche, but don't get a cost egg. Doesn't make sense for you. Um, like I have a client, we have a client that did a cost egg on a $35,000 house. And it's like $35,000, you're only saving $2,000 on your taxes. Is it really worth paying for it? Yeah, because then now he has 6 properties a year or 2 later.
Mm,
So just get started, get that first one in, and it'll flip. Like the biggest misconception about cost egg is that they don't know about it. Because in order for you to get that $1 million or $100,000 deduction, you got to buy $1 million or we'll say $100,000 car. So would you rather
Right.
be on the hook for $100,000 car to get that $100,000 deduction, or would you rather have that $100,000 deduction and only pay, you know, 3 grand for it?
Yeah, that's a great analogy.
yeah, I like that.
So
Okay, favorite way to decompress?
now it used to be Top Golf, but now it's playing with my son, who also
Oh.
causes the compression.
How old is your son?
9 months.
Oh, the fun
Yeah.
ages. You're just coming to I love it when they're, like, no common sense, look like little drunk people walking around that,
Mhm.
like, you're about to be there, that 12 months to, like, 2 years old. Oh,
That's so
that's
fun.
when I wanna steal people's children is that
Yeah.
age. I'm
We
like, "They're
just
so
borrow.
cute." Yeah.
Okay, one thing you wish more investors understood.
You'd be surprised at how many people don't know this, but taxable revenue is revenue minus deductions equals taxable income. And not knowing that depreciation from a cost seg study is included in that deduction part
Mm.
of the equation.
Oh, wow. I did not realize that people wouldn't realize that.
Yeah.
That is interesting.
Yeah, someone like me, uh,
Yeah, that's true.
yeah,
Danny wouldn't.
yeah, yeah. That's why it took me I mean, I spent hours and hours so our mentor, Vinny, he had, some, who do you have? A couple cost seg, people like yourself on, and I would listen to it over and over and over. It was hard for me to really grasp. And when I'm, pitching deals and stuff, and I talk about this cost seg, there's some people who it's like me in the beginning, way over my head and their head, but then some, really understand it. So, yeah, for sure.
Well, it's just different personality
Yeah,
types.
yeah. I'm not the analytical engineer type like you and Marissa.
Yeah, I like
I
spreadsheets are
mean,
my best friend.
another thing, like another way to look at it is for someone contemplating about buying a property and needing to spend 20 to 30% down, that's cash out the door. But if you were to do a cost seg and this tax bill passes, you'd be able to recover that or offset that 20, 30%
Mhm.
down payment
Mm,
via deductions, 20, 30% down deductions on your taxes.
Yeah.
see,
So you can you can make the burden of that down payment much less
Yep.
doing a cost seg immediately and filing it on your taxes.
okay, last question. What is next for you?
Um, we're on baby number 2, so getting my wife through the next 8 months of that,
Exciting.
and then hopefully buying a nice big home or a bigger home than our condo.
That's awesome.
Good for you, man.
Congratulations. That's
Thank
Are
you.
exciting.
you or do you know what you're having, or is it a surprise?
I have a feeling it's a girl, um, but other than that feeling, I don't know yet.
Gotcha. I have
Yeah.
2 girls.
Yep.
So if you have a girl, they are amazing.
You'll
I,
always be taken care of.
that's what I hear.
Yeah. You're
Not
still
yet.
waiting for that.
Not
They're
yet.
13 and 10. Let's just say they care nothing to do with us and just wanna hang out with their friends at this point, so we're
Yeah.
fine.
Okay, so thank you so much, Anson. This is the first time I've actually seen your face.
Yeah, we always
Um,
talk to you on the phone.
yeah,
Yeah.
yeah. You have been amazing.
Yeah, huge help.
Such a huge help, such a big part of our success.
Yeah.
Core is they are awesome. I can't speak any higher about them. They're
Yeah, customer
professional. Yeah,
service, responsiveness. I mean, it's
yeah.
just great.
So, CostSeg changed the way that we structure our deals,
Yeah.
and more importantly, the way that our investors keep their money, which is number one. And if you're looking at a CostSeg as part of your strategy, you're leaving real money, or not looking. Sorry, if you're not looking at CostSeg as part of your strategy, you're leaving real money on the table. And if that 100% bonus depreciation bill passes, we're going to be buying like 10 more deals this year. But it's going to be like hitting the rewind button on the last 2 years tax planning, and such a bigger refund, and better for everybody. So big thanks for Anson
Yeah.
and the team at Core Solutions. If you got deals in motion or already closed up, this is the time to make your move. So we will drop their info in the show notes. Catch you on the next episode. Thank you for watching.